Many traders like the fast action of a 1-minute chart. Only a few who do can trade it consistently. Daniel Munday prefers the higher timeframes. It doesn't surprise me because everything about his demeanour exudes patience and humility, a far cry from the picture of raving traders in the land of Wolf on Wall Street. It's only fitting, perhaps, that Daniel not only prefers trading the higher timeframes, he also enjoys mentoring other traders. Here we are in his spotless apartment in southwest London, middle of May 2024. Daniel, you've been trading quite a few years now. Talk me through those early stages up to the turning point and what actually made things really work for you on a sort of consistent basis.
So I think early days I had a bit of initial success. I wasn't one of these traders that came from blowing accounts, getting scammed or whatever. I learned the right way. And I think as a result, my initial trading was quite steady, slow returns. And I understood that that's what we were looking for in the markets rather than, this turning £300 into Lamborghini lifestyle, right? So I think the transitional point for me was when I was suddenly earning more trading than I was in the day-to-day job, and it actually became a hindrance to my trading. So I would then miss trades, and obviously with any system you have to execute every trade. If you're missing trades in a year's worth of data, you might miss all the winners and take all the losers. So it was becoming evident to me that I was going to work missing certain trades that were then working, and that becomes part of my data. So for me it was a case of transitioning from that day job to full-time trading, and it kind of coincided with the place I was working closing down, so it all sort of fell into place at the right time. But that then led on to probably the most stressful year of my life, which was suddenly I was fully reliant on trading as an income, and I didn't realise how much of an emotional effect that was going to have on me. It was not a great year for trading. I really struggled because suddenly I wasn't just trading the system and the edge with a probability A win, probability B loss. It was, right, I'm trading to pay my rent, I'm trading to do the food shop, pay my bills, and that brought a whole new mindset, psychology, a journey that I had to go on to sort of, and I wouldn't recommend that for anyone, any trader. I think especially early days, every trader needs to have some form of either savings aside that can support them for X number of years, or a day job, whether it's just something on the side that pays the bills. But yeah, that was a tough time, hard year.
Just a quick one. Mental performance, discipline, patience, psychology. We talk about this a lot in trading, and for good reason. It's a tough game to crack. Well, I've come across a little drink that helps with the mental performance and the focus. It's called Magic Mind. It contains various antioxidants, matcha, which is found in green tea, it contains bacopa, which helps with memory, various mushroom compounds, again helps with memory and concentration, vitamins B and C. That cocktail of good stuff helps boost mental performance. I've been trying it for a few weeks and really enjoying it. It comes in a little bottle. It's just a shot, like knock it back, 1 or 2 swallows and you're done. Tastes a bit like passion fruit, I'd say, not sweet, suits me. And I swap out my coffees and teas and what have you in the middle of the day, and I find I get a more sustained boost without the crash or the heavy spikes and the jitters and all the rest of it that you get with heavy caffeine kind of drinks. So if you want to give it a go to magicmind.com/atraderslife, enter the coupon code TradersLife20 to get 56% off a subscription, 20% off a one-time purchase. If you don't like it for whatever reason, you can write into the company and they will give you your money back. So give it a go. I enjoy it. Might just help with your mental performance during the day. Okay, back to the show. So going back to that year where you were just making ends meet, right, with your trading through that difficult period and having to pay the bills, which is pretty difficult. What enabled you to, when we talk about mindset, what enabled you to overcome the funk and the fear? And, obviously you must have had some bad days or weeks, But what enabled you to push through those? And I mean, was it mainly kind of technical and knowledge and you improved on that score? Or was it you kind of more got on top of your psychology?
So for me, it was really psychology. The technical side of trading, I don't actually think is that important. You learn an edge, provided the edge is profitable, and that's based on back testing and data, then applying that edge comes down to your psychology, right? So for me, in those early days, it was a journey. You know, it was very much about becoming a better trader through my mindset, through controlling my emotions and things like that. Obviously having to pay your bills as a trader solely from your trade account. And this was a time when, you know, there was no funding, there was no prop firms, this was purely my own money that I was trading. You're going to make decisions based on what you need to live, or, you know, the bills you need to pay. So it was really, at that time, a case of taking on some part-time income. So I took that stress away from myself, which would then say pay the bills, pay the rent, and then focusing on trading as just a process rather than a process of paying bills. You know, it's just a process of execution. You have an edge, you execute the edge robotically. There'll be winning days, there'll be losing days, there'll be losing weeks, losing months. You know, there's no escaping that. Anyone that tells you there is, they're lying. They're probably a fake guru selling a course on social media. But I think the key with any trading platform, or any trading system, sorry, is data, is having that back-tested data behind you to tell you that this is what the system generated through the whole year, through 2 years. And as you move forward, you have that, I don't know the word, but you have that, you're convinced, or you know that the system is going to continue to bring in those potential returns. And where most people fall off, I believe, is where I fell off those early days. You know, I had a system that I knew that worked, but suddenly I wasn't then executing that system as I knew it worked. I was executing the system, but with all this emotion attached to every single trade. And as a result, my results were varied. You know, it was all over the place. I can very distinctly remember a month where I hit 12.5% in the month. It was a phenomenal month. Going into the next month, we were 3 days from the end of the month and I was 4% down. You know, I was trading. Now I don't trade anywhere near that sort of risk, but back then I was, because I was trying to pay bills. And I remember 3 days towards the end of the month, it was a Friday, so Saturday, Sunday were 2 of the days. So that Friday I was just looking for trades and I didn't have anything on radar, and I ended up taking trades because I was trying to make the monthly income, you know. So having some form of support, backing, financial backing, a day job, whatever it is, especially when you're in those early days of learning, or you even have a system and you're looking to take that potentially to an income, to a full-time income eventually, is really important in my opinion.
And what do you trade and why? Did you start with Forex, stocks, a mix of things?
So I actually learned to trade from a futures trader. So when I initially started, you know, what I was taught, I was told, would carry across to every market. You know, they work the same way, essentially. But what I found myself trading early days was Forex, just simply because the barrier to entry was minimal. It's very easy to get into. Futures was very different back then. I'm not sure what it's like now, but in terms of investment and what I needed for an account and things, I didn't have very early on. So it was Forex. And now I still trade Forex, but I also branch out to quite a few other things. So I trade a little bit of crypto, but it will be very much intraday stuff. I'm not a long-term holder. I'm just trading the same patterns that I would trade on FX. I do trade a bit of oil, crude oil, some commodities like gold and silver as well. More so in the past. The last year or two, I focused quite heavily on Forex. And the main reason is because with the strategy I trade, I tend to look at what's moving the market. So I find it very easy to correlate Forex pairs. It can be quite difficult if you're trading gold to determine what's moving gold at any given time. It could be, you know, geopolitical tensions, war escalation, whatever, or it could be something to do with dollar interest rates. You know, there's a lot of things that can move gold, risk on, risk off, etc. Whereas looking at a Forex pair, you kind of know you've only got two things that could move it. If it's New Zealand dollar, US dollar, then it's either the New Zealand dollar moving it or the US dollar moving it, right? Yeah, there's some carryover with risk into FX and understanding if, say, the S&P 500 is driving really hard or selling off really hard, there is going to be a carryover into the dollar. But for me, my expertise, I would say, lies within Forex.
Okay, so you mentioned strategy. What is your strategy? Can you give us a breakdown of what you're looking for? Is it supply and demand? Is it, are you using tools like Fibonacci? Just give me a rundown of how you trade Forex today.
Yeah, of course. So the foundation of how I trade is levels. I look for levels within the market. They may be break and retest levels. They may be line chart equal highs and lows. They might be less so nowadays, but multi-touch zones, areas where we've seen a lot of reaction previously. But for me, it's all about the level as one. And then secondly, it's all about market alignment. So as I mentioned before, we're looking at the New Zealand dollar, US dollar as an example. There's one of two things that could move that, New Zealand dollar or US dollar, or stocks, if there is big stock volatility that day. But if it's New Zealand dollar and we're looking at, say, New Zealand dollar yen as a trade, and New Zealand dollar is driving the market's not going to stop at your level on New Zealand dollar yen unless New Zealand dollar US dollar hits a level at the same time. And that's because that's the FX major, right? So that's where the volume is. That's where the majority of traders are looking. So what we tend to do as a group in my mentorship is we look at the drivers, so the majors. We understand where we think they're going to stop within the market. So at a level, using our key levels, break and retest, multi-touch zones. I do use a couple of other confluences as well, so Fibonacci being one of them. Waiting for those majors to hit those zones and then cross-correlating that with maybe the pair that we're trading. So if there's a strong US dollar move in the market, for example, we would cross-reference Euro US dollar as one of the biggest or most traded FX pairs, pound US dollar, and then the Dixie. So cross-referencing all three just give you that edge in the market to say, okay, I've got a level on Euro US dollar, but I've also got a level on pound US dollar here, and I've also got a level on the Dixie here. They're all hitting at the same time. You'd be really surprised how often all those pairs line up and move off of technical levels together. So really, to summarize the strategy, it's key levels, utilizing some other forms of confluences, Fibonacci. I use a couple of EMAs as well. I'll draw a trend line on a chart because there is power within that as well. But it's utilizing the key levels with market alignment. So checking what's moving the market, why it's moving the market. If it's stocks, and that's then having an inverse effect on the Dixie and the US dollar, where are stocks going to stop? Where are these buyers looking to take profit potentially? And if we get to some form of level, a big psychological round number, and then suddenly our Euro US dollar pairs lining up, a nice area as well, the chances are that trade is more likely going to work. I hate to say that it's going to work because we never know, it's a game of probability, but you're stacking the odds in your favour in that instance.
Where do fundamentals fit in with your strategy, if at all?
So they do come into play, but I don't overanalyze the data. So as a technical trader, my opinion is the technicals become obsolete when the fundamentals are driving the market. So if we have really strong CPI data on the US dollar and we're looking at selling US dollar at a level, the chances are that level's not going to hold up, especially within the hours following that CPI data. And I learned that through collecting my own data the hard way, trading those levels that I thought technically were going to work, and CPI data, we just blasted through them. But at the same time, if the data's not that strong and we get a strong move into a level, the chances are that level will hold up. So there is an element of analysing the data and seeing how far from consensus we are. But I don't go diving into it pre-release. So if we've got a release coming up, I don't go looking at what's expected of the data, what am I going to do leading up to this. I won't be in a trade most commonly if we are coming up to, say, a CPI release or monetary policy, Fed rates, etc. But I'll be aware of that coming up, and I'll make sure that I haven't got things like sell limits, buy limits at levels that I liked previously, because the chances are if the data's stronger or weaker than consensus, those technical levels get blasted straight through. So there's an element of fundamentals to it, but we don't sit as a group and overanalyze what the data might be.
So you'll sit out the 1:30 UK time kind of news where we get these huge spikes, usually on the dollar, but it can be on any of the currency pairs, for example. You'll just sit, observe, not try to play it one way or the other, just wait for it to calm down for, say, 20 minutes or so? Is that
Yeah.
Okay, that kind of picture?
Yeah, so like 1:30 we might commonly see an NFP release or a CPI release, something like that. I'll be looking at the release, so I'll just be looking at the numbers, how far from consensus we are. If we've completely smashed consensus, then I'm not going to take the other side of that probably for the rest of the day. So I'm not going to try and pick a top on the US dollar if the numbers were way past expectation. Like I said, I learnt that the hard way. I've tried that in the past. It doesn't work for me. It's not consistent. But if the numbers are near to expectation, you know, and they're not something that the market's been waiting on really heavily, then I'll take the other side of it if it's not driven the market to huge extremes. So, you know, we're this month we had an NFP release that created quite a lot of volatility, but there wasn't a huge discrepancy in the numbers expected. So I did take the other side of that, and, you know, fading those kind of releases works really well. But if the numbers come out and beat expectations, then it's not just 20 minutes, an hour after I write the rest of the day off. I'll just accept I'm not in this move. It's going without me. I didn't have a trade on from earlier that day or whenever that was locked in with a stop at break even to let run, you know. So at that point, I'll just walk away, turn the computer off, come back the next day. And quite often, you know, you see a lot of retail getting stung, getting burnt, trying to pick the top or bottom of a huge move like that, when really there's no fundamental reason that thing's going to turn. So it doesn't make a lot of sense to me. In terms of sort of when I'm looking at the markets, I'm on the charts every day. So first thing in the morning, as soon as I get up, I'm scanning through, looking at the levels that are potentials for the day. But I found this year, London session has been dead. You know, the markets haven't moved at all through London. If we've had some big news through Asia overnight, then it tends to move the markets a bit more. But London session on a no news day, or even a US news day, tends to just flatline, and then we're waiting for that 1:30. You know, it was always said that London traders had it best because they get to see all the sessions. You get to see London, New York in the afternoon, Asia you're asleep, that's the quietest part of the day. But I would argue now there's often not a lot of need to be trading, especially as a higher time frame trader, London session, unless you're trading 5-minute, 1-minute charts, you know, coming from the Asia range or whatever, smart money concepts kind of style trading. Those big high time frame levels, they get hit when there's volatility through the New York session. So markets have changed a lot this year, I'm finding.
Yeah, I mean, I found in London, the London session at 8, you know, you got some days where there's a bit of volatility in it, and if you're on the short time frame, you know, if you're on 15 minutes or something like that, or 5 minutes, you can make some money, definitely. But the 4 hour, which is mostly what I understand you trade, or daily, it's almost not worth it. I can see where you sit out on that. And then we sort of just about find some direction, it seems to me, around about 9 o'clock. Even then it's quite ambiguous. 10:30 you might see a clearer direction, but then we're kind of coasting a little bit in terms of volatility until about 1:30, and then usually you have this huge explosion. It calms down until 2, and then really you've got the American session. But you know, it's like the time we're doing this interview, it's around about midday, isn't it? 11 o'clock we started. But you know, that's a very quiet time usually now in the markets, certainly in forex. I mean, I've also found it to a certain extent with the indices, you know. Yeah, I don't know quite what that is. It seems to me like it's a market that's really unsure where we're going, and it's just waiting for these catalyst announcements, you know, the CPI, the whatever might be coming out, as the kind of right, that's our direction. And then the next day it does the same again, pretty much. I've found, as you have, you know, these months, certainly the mornings have been quite slow. Yeah. Whereas, as you said, you know, a lot of people will say, well, that's great, you've got the London session and quite a lot happens, and then you've got the New York session. But, I mean, the Asian session, you know, nothing much happens at all recently, if you ask me. No. But, yeah. So, when you're looking for a trade, and I know you spoke about levels, what else can you tell us that you're looking for on a 4 hour kind of time frame? you're going down, you're seeing something in the market that gives you a direction, and then you're perhaps looking down, further down to the 1 hour, the half hour perhaps, as a kind of entry point. What is it you're seeing besides levels, if anything, when you want to take your trade?
Yeah, so I'm also using round numbers. I use round numbers and 50s, big psychological numbers. You know, if I was to break the strategy down, I'm looking for a push from point A to point B and a pull back to point C. So it's very simply, I'm trying to trade the trend, but I'm not so strict with that as to say, well, I'm not taking this push from point A to point B and taking the point C because the trend's now changed, because you've got varying trends on every time frame, right? You've got a weekly uptrend, a daily downtrend, a 1 hour uptrend, you know, it can vary. So I'm not so strict as to say I'll only go with trend, but essentially in essence, that's kind of what it is, because it's a push from point A to point B, which is a trend, right? And then a pullback, of which we're looking for an entry, of which we would hope is a Fibonacci number, a key level, some form of level break and retest zone, equal high, equal low. One other thing that I utilize with my group as well is in extreme times of volatility, we look at the average true range of a pair. So if you're looking at the euro US dollar, for example, we know it averages about 55 points a day. If we have got that extreme volatility in the market and it's moved 100 points, we know we're twice over what it would normally do over the average 20 previous days, right? So we then will be looking to take the other side of that, because those people that have taken that and got a 100-point move out the market are going to be looking at taking profit sometime. And obviously that could then inadvertently create a reversal within the market. So we do look at that as well. But you're really, you know, it's right what you said about the London session. I used to trade the pound pairs at London Open. So I would use market alignment exactly the same as I do now, but I would just trade the pound because there was enough volatility trading the pound that I didn't then need to look at any other pairs. Maybe sometimes I'd look at Euro, New Zealand, Euro, Aussie, because they move quite a lot, but it would just be 5 pound pairs that I look at every morning in correlation. You know, the 8 a.m. bell goes, the market starts moving, I'm looking at a potential breakout, which one's moving the quickest at the open, is there anything in the way of these, you know, and I'm looking at them all on several screens at the open. You can't do that now. If you looked at all those pairs at the open now, you know, it's like nothing happens, absolutely nothing happens. The market doesn't move unless there's obviously 7 o'clock news. I know the pound used to have 9:30 news, so they suddenly changed that now to 7 o'clock over the last couple of years. But that strategy wouldn't make me money, it wouldn't give me any trades. So, you know, the market has changed significantly. The principles are still the same for me. The market alignment, utilising the key levels, the round numbers. I've always traded off round numbers. You mentioned there a bit about sort of 1 hour, 15 minute. I rarely go down to those time frames because I'm not looking for confirmation of a level working. I don't look at any sort of candlestick patterns or anything like that. It's always limit orders. So if the market's coming aggressively down to a 0 and I have a reason to buy it, I'll just buy it. I'm not waiting for it to reject. You know, I may have given up 20, 30 pips of the move there, and that might have been all I was looking for. So I'm quite aggressive with the entries when we get to those levels, but really I need the volatility. I need a strong push into those levels. And through Asia, we certainly don't see it unless there's some form of news on the yen, New Zealand dollar, and London. We don't typically see it unless there's big pound news, CPI again. But it's certainly changed. I mean, yen pairs I found this year to largely be a write-off. I haven't been able to pick levels because of this Bank of Japan intervention, which is always being mentioned. Are they going to intervene today? You know, and then all of a sudden they say something, we get a 700 pip whip, you know, and I'm not going to have pending orders in that market. Chances are they're going to get wiped out. So yeah, pound yen used to be one of my favorite pairs to trade, pound yen, euro yen. But nowadays I still look at them, but I rarely trade them.
Yeah, I think it's too risky.
Yeah, it's crazy. I think last year it was November or December. It might have even been October, but it was around that time when I remember looking at the ATR on dollar yen, and the daily candle was 700 odd pips big, and I all day had been trying to figure out where I wanted to buy it. You know, I think I'd been burnt every single point that I looked at buying it. And there was correlation as well. You know, you had the Japanese index moving with it. that was coming to some levels. That actually really increased my understanding, that point last year, in how the stock market influences currency, because that particular day, all those yen pairs kept blasting through every technical level, you know, and that, I think pound yen candle was like 700 pips, dollar yen may have been 500, 600, something like that. But they all stopped when the Japanese index finally hit a level. And as soon as that hit a level, all of those yen pairs reversed, huge reversals as well. So just waiting for that. And I've always looked at the Nikkei, the Japanese index, but that particular day I was quite zoomed in on US dollar yen, you know, as the major pair. That's what's moving this, that's what's driving this move. Where do I want to buy pound yen, euro yen, all these other pairs? And then actually realizing, okay, this isn't anything to do with the yen. This is all to do with money flowing out of the stock market at this point. You know, the stock market was selling off really hard. Money's coming out of the Japanese index, therefore going into cash, therefore cash is going up. So understanding that correlation, of which I'd always understood, but I never directly applied it into waiting for an actual entry for a trade. And now applying that same principle to the S&P 500 and the dollar works really, really well. It's just at the moment, we are, like you say, at this point where the market is very indecisive, very sideways. We know that every country wants to bring rates down, apart from the Japanese, obviously, but every country wants to bring their rates down, and it's sort of like, who's going to be the first to do it? Are the US even going to be able to do it with the figures they're printing? So there's a lot of indecision, uncertainty, and it's meaning the market isn't flowing or trending quite like perhaps what we're used to, especially even last year.
What are your Forex pairs these days?
I'll look at 28 Forex pairs. I look at everything because I'm looking for higher time frame levels. There's not enough levels that are going to get hit on, say, a basket of 5 pairs at the moment. So in previous years where I could niche down on, say, the pound, and I might introduce a couple of euro pairs, that was fine. You know, that would generally provide a couple of good setups a week. At the moment, looking at 28 pairs plus gold, plus oil, plus silver, plus Bitcoin, plus, you know, plus everything, the DAX, US 30, US 500, I look at everything. That is providing maybe 1 or 2 setups a week. So there's a huge change in the markets, and you know, a lot of traders always say you shouldn't change your strategy or change your edge. And I always say to the people I mentor, you know, we haven't changed our edge, but we're changing how we're applying that edge, because we have to. If you don't adapt, then you're just going to get left behind. This
is less timeless, because I'm going to ask you about what you think of the markets now in terms of the fundamentals, you know, as you said, the interest rate, where's that going versus inflation and so on. And of course that other big question, debt, how is that finally going to impact not just on your currencies but also the stocks? That's an obvious one. What's your take on, we're now in May, middle of May 2024, have you got any feeling of where things are going in the next 6 months?
Yeah, so one thing I'll say, Nick, I'm not a speculator. I'm a trader. I trade a probabilistic system, right? So speculating on where things are going to go long term, I find very difficult. You know, I'm not good at that. Previously, I might have been better, pre-COVID, I would say. Since COVID, I think anything can happen, right? So we saw a period through the markets there that I didn't think we'd ever see. Oil at minus $40 a barrel, you know, 1,600 point swings on pound New Zealand dollar. It would start the day, push 1,000 points up, and then retrace 1,000 points by the end of the day. And that was very much a case of, you know, I used to have this saying with my friends actually, and it became a bit of a joke, but it was I'll eat my shoe if this doesn't work. You know, I used to say that quite commonly to a couple of guys I trade with, and I couldn't ever say that now.
You ate too many shoes.
Yeah, yeah. But I never feel like I know, because we saw that period through COVID, and then I feel like, well, anything can happen now. You know, and I think that's what brings the uncertainty to the market. You know, the fact that we did see those extremes, and not just in trading, you know, in every walk of life, people now realize that these things that we've seen in movies, you know, like global pandemics, can actually happen. I knew a trader actually at the time who had a global pandemic clause in his contract for investors, and I can remember reading it thinking, well, you know, global pandemic, you just ignore it, don't you? And like 2 years later, he's suddenly pulling that clause saying, we're here. So the period we're going through at the moment of this uncertainty, I think also stems from COVID, with the fact that investors are a bit more scared to move their money around now because, you know, those eat your shoe trades that we used to have don't happen anymore. It's a case of, well, I don't know if this is going to work, or, you know, it's very difficult. So in terms of what's ahead, I think a lot more uncertainty, definitely. In terms of stocks, I'm really surprised to see, so today they're back at all-time highs, right? The S&P back at all-time highs. I'm surprised to see them there, to be honest with you. But like I said, anything can happen. So we started the year, I had a sell on the S&P 500 at the start of the year. 7 days into January, I was flying. I'd had US dollar CHF longs, US dollar CAD longs, and stock market shorts. And they all came in within 7 days into the first month of the year. And I thought, that's it, I've got the high of the year. I've got the high of the stock market. That's long gone. You know, we've smashed through that and we've gone higher. So I really don't know long term, and I think anyone that says they know has no idea. If you look at the economic projections for where the S&P was likely to end up last year from Barclays, Goldman Sachs, I mean, they were thousands of points off. So I read a thing that said, don't worry if you didn't get it right this year. Nobody did. You know, none of the big banks, none of the big institutions, they got it wrong by thousands of points, you know. So
Do you trade stocks at all, CFDs, or do you go in without leverage, for example?
No, not really. I don't do much with stocks. I've advised a few friends that have asked me to take a technical look at stocks, you know, basic sort of mean reversion plays. So if they're bottoming out and we've got a huge distance to moving averages and we're getting heavily divergent and they believe in the company, then great. That's a, you know, potentially a really good investment there. And I do believe I could do pretty well looking at stocks more, but my edge lies within the currency markets, you know, within CFDs, within looking at some of the indices. So I don't necessarily feel the need. I'm already looking at so many charts every day, then starting to sieve through a stock scanner and looking at loads of different companies and reading up on their earning reports and things. It gets a bit much. You know, I'm quite risk averse when it comes to investing outside of my trading. So if the bank's giving me 5.5% fixed rate on an ISA, I'm gonna take that. You know, I like that because my day-to-day trading is high risk. Therefore, if I have something very low risk in the background, then I feel very happy with that. So no, I don't tend to look at individual stocks too much.
So we talked a little bit about your strategy and how you apply that to your own trading. You learnt through a mentor how many years ago?
So that would have been 2013, so 11 years ago now.
11 years ago, so that's, you've been trading, well, we're now 24, so yeah, it's just not long after really the crash. But you learnt with this mentor, you've been trading several years. When did you yourself decide you could teach one? Was it like one or two people? Did you bring them into a kind of community, like a Facebook group or something like? Talk to me a little bit how you built up your mentorship program yourself.
Yeah, so 2013, I learnt with a guy called Sam Evans. He was mentored by another trader called Robert Dunn. Robert Dunn worked for Goldman Sachs. He was on the floor of the Chicago Mercantile Exchange when the S&P 500 was launched. And I was lucky enough to spend some time with him as well. And, you know, I was lucky because I learnt to trade before this whole social media craze. So I was told if I could do 15–20% in a year, you know, you're a god amongst traders. That's phenomenal. If you can consistently do that, you're one of the 0.1% of traders in the world. But obviously this whole social media thing came about, Instagram, flashing Rolexes, supercars, all that kind of stuff. I don't know when that came about. I think I became aware of it perhaps around 2018. And I can actually remember sending a message to someone I knew very high up in trading and saying, you know, look at these guys, they're making unbelievable money trading. What are they doing differently? I don't understand it. So I was sort of sucked in a bit by that and thought, how's this possible? But I was told straight away, you know, it's not possible. That's not what they're doing. And I really feel for a lot of people because they went down that route, they got scammed, they believed that it was possible to turn £300 into 10 grand or make a salary from it. You know, it was crazy some of the claims that they were making. And I think I was very lucky not to get sucked into that. But at the same time, I did have friends that wanted to learn to trade. So it was during COVID that I started, just before in fact, that I started just teaching a small handful of friends to trade. And it was really because they'd asked me if I could show them a few things, and I decided, okay, I could put together some form of mentorship or do an in-person course and teach these people how to trade. And I started off teaching one of my friends, Sam, who's a good trader now, Sam Gaines. He trades with sort of max allocation for prop firms, who does very well. Still has his day job, which you know, he's very successful in, but trading for him has become very lucrative. And that branched off to another mentee who's become a good friend, Ollie, as well. And these guys did very well. Another guy, Sam Gaines, there's four of us, Sam Coots, sorry, the four of us trade together, and we have done for a long time. You know, I realised that these guys were doing pretty well, and during COVID, obviously we had a lot of time at home. Everybody was, you know, twiddling their thumbs, and I thought, why not set up some form of group? We're all sharing our trades with each other every day and talking about the market, so why not open that up to some form of subscription model, right? So there was a lot of people online I recognised making huge money mentoring, and obviously, as my mentors had told me, they weren't taking any trades themselves, these guys, so be aware of that, and girls. So, you know, I thought, well, there's a gap in the market then for some form of proper education, and I made sure from the very get-go that it wasn't about we're going to make X amount of money. You know, this is a game of probability. I've had people in my mentorship that have left after a string of losses, right? Because they're still looking at trading as that way of making a salary within a minimal deposit, or learning it within 4 months and becoming a master trader. But the people that have stuck it out long term with me in the mentorship are people that recognise what real trading is. You know, it's a game of probability. I said to you earlier on, you know, the result of any trade is a result A, result B, right? So one is a win, one is a loss, but there should be no attachment to the win, and equally there should be no attachment to the loss. If we're playing a game of probability, we need enough data to know how the edge works, and you've got to sit through all that data in live markets, essentially. You could have 4 losses in a row. If you're trading at say a 50-60% strike rate with positive R, there's no reason why you're not going to have 6-7 losses in a row, which psychologically is quite hard for people to handle. So trying to teach people to trade the right way and understand that it's a game of probability, there are losses, they're normal. It's part of what I do, but it's also been quite challenging. You know, there's some people that I've taught that have really struggled with losses. I think we mentioned, or I mentioned to you previously, that I taught a trader a number of years ago who was very, very successful. They were a surgeon. They came to me to learn to trade, and they said within a few months, I'll never be able to do this. I can't do it because your strategy is generating around a 70% strike rate here. So 3 out of 10 trades on average, I'm losing. He said, I don't go to work and operate at 70% strike rate, so I just can't manage the two. He said, I understand it. It was very academically intelligent. You know, I understand it, but I can't apply it. It doesn't fit with my personality. So therefore, I'm never going to be able to do this. I'm quite happy just leaving my money in safe, steady, slow investments and forgetting this, which, you know, was admirable because they were able to just step away. Whereas a lot of people aren't. They're hopeless at it. They can't think in probability, much like many of us can't, because when we're kids, we're told what's right and wrong, and it's very black and white, isn't it? You know, if you do something wrong, no, you don't do that again. You do things right. But in trading, the only thing you need to do is execute the plan over and over. And sometimes the result that generates is the wrong result. It's a loss. But it doesn't mean you did anything wrong. So it's quite difficult. All through the school system, you know, it's a test. It's a right answer, there's a wrong answer. There's not a probable answer that gives you a X amount correct, you know. So it's a really difficult thing to learn and understand, and that's sort of what my mentorship is about.
So talking about losses, obviously that has got a lot to do with somebody's character or personality. And how did you deal with that in terms of your heavy losses? I mean, did you find, or do you think that you have a strong resilience innately, or is it something you've had to work at, you know? And then also, having achieved that for yourself, what are the kind of tips you would offer to anyone listening to this or your own group?
Yeah, so this is a funny one, Nick, really. I started off with a really good mindset with probability, and then in 2018 I actually saw a really successful run where I took like 21 trades in a row that worked, and that was actually, I wish that never happened, because I started to think that I shouldn't be losing, and at that point in time I just hit a good run. You know, we all hit those runs like we hit strings of losses, and I turned quite a small amount of money into a reasonably large amount of money on the side of my main trade accounts, because I started to feel a bit invincible. You know, everything I did was right, and I was like, well, I don't get trades wrong. My strike rate's nearly 100% here. It was 100% over 21 trades, but that was at the start of the year. So that year I was like 100% strike rate. And then when I started to lose trades off the back of that, I started to slip back into that mindset that I'd had right at the very start of trading, which is, what am I doing wrong here? You know, why didn't this trade work? This has worked 21 times now, and suddenly, you know, this one hasn't worked. And that year actually went through quite a big psychological battle with myself. So, you know, I did all the classics, reading Trading in the Zone, studying everything Mark Douglas says, you know, about probabilistic thinking. And it's easy to understand that, but it's much more difficult to apply it, especially when you're caught up in the emotions of a trade. I'd got to this point where my heart rate would go up taking a trade, or I was losing sleep because of a trade, where the years prior I'd not had that. Only the year where I was trading and trying to make rent, pay my bills, etc. But this particular year I'd had that string of wins, and then I'd taken a few losses, and all of a sudden I started to feel like I don't want to trade anymore. I'm not enjoying it. I'd lost a love for it. And the more I pushed through that, the better it became, because the more I started to realise, actually, I don't care so much about this anymore. I started to become a better trader again. So it was sort of a big full circle. I think if you put too much weight on trading, you suddenly start making a lot of mistakes. You have a lot of emotion attached to the result of a particular trade or particular month, particular week. But I read something the other day that a really successful trader had said they have no interest in trading at this point. You know, and that was really interesting to me, because I do enjoy it. I enjoy breaking down the markets. I enjoy the analysis side. You know, I enjoy the mentoring side. So I do enjoy it. But reading about this particular Japanese trader saying that they have no interest in trading at this point, because it's just a system. It's just a process. You just execute over and over, and they don't tend to look at their P&L until 6 months into the year. So it doesn't matter what their P&L says. The system is the system. That was quite eye-opening for me, even as recent as just a month or so ago, you know, when I read that. But I could see how I'd done a very similar thing, where I'd had the euphoria of all the wins. I'd had this small account into big money. I'd had my personal funds, and I was trading for a particular person. Then we had a joint account which had done really well. So, you know, they were praising me, wow, you can't call a trade wrong, you know, and all this. To then suddenly taking a few losses, thinking, actually, I hate this. I hate trading now at this point, which then in turn made me a better trader again, because I was like, well, I don't really care about trading, it's annoying me. And then all of a sudden I started executing well again, probabilities playing out, and not attaching so much emotion to it. So, you know, most traders, I think, go on a journey, right? A psychological, emotional journey. I'm no different to anyone. I've been through all the same things that every one of my mentees have been through. Gambling, over leveraging, trying to turn small money to big money. Oh, I can't lose, you know, then suddenly losing. Every time you step out of line with the markets just give you a quick slap and say, get back in line, you know. So, and we've all done it, haven't we?
Yeah, for sure.
Yeah.
Yeah, no, I was going to say, my experience very similar. In fact, the last time I went through a really bad period, the only way I think I got through it was by saying I don't give a shit anymore. It's just like, oh, sod it, you know, there are better things in life to do.
Yeah.
And then bizarrely, that helped me sort of calm down the emotions, because obviously if you don't give a shit, you're no longer getting that kind of upset, and you're no longer beating yourself up about anything. You're just going, right, okay, I don't care. And just focusing on one or two things that you might be able to achieve that week and nothing more. No kind of, oh, well, I'm worried about the end game, or I'm finally now going to break out and make lots more money. No kind of scenarios, in other words, just really minimal steps, trying to improve what is kind of right in front of you, and not get no more emotional kind of upset about any of it. And that is the surprising thing, how you realise, gosh, my emotions really were getting in the way. And as you were saying, you were either taking a trade that's too large a size, or you were, scaling in too much. All these kind of usual problems that we do when we sort of get upset about ourselves, and we think, well, revenge trading is to a degree part of that problem, isn't it? But I think, going back to what you were saying about people coming into trading thinking they can make loads of money, I mean, 20% on a year, let's say even 50%, you do well. Well, why is it so many people go into trading and not even do the basic maths? Because 50% on 10K, for example, let's just say, I mean, most retail traders don't start with 10K. So 50% on that in a year, it's not a lot of money. It's not a salary. No. It's not a Lamborghini. It's not, So really, unless you're coming in with, your aunt's inheritance 50K or 100K or whatever it might be, you're not going to be able to start off thinking of trading as your full-time job unless you're happy on living on very, very minimal, subsistence. So I think this is an important thing, that people get real about trading. I mean, it's one of the things I like to get across in this podcast, because I think, too many people think that even a sophisticated, successful trader is earning an absolute fortune. They might be if they left, one of the big banks, and they made a lot of money, and now they're doing their own trading. And also, prop trading does enable you, because you can open multiple accounts and you can have, I suppose, a couple of million, and be doing that. But you're talking, again, about a tiny percentage of people who can do that, because it's not like you just have $1 million and can trade it as you would your own personal money. You have to stick to very, very tight rules. Most of the people who pass those tests go in, blow their account after a few months, and they're back to square one in most cases. I hate to sound so disparaging, but I also like people to be real. And I think the quicker you get real in trading, the better your chances, really, of actually making it work the way you have,
Yeah, so I think, with prop firms and how they've evolved, that's now become what was the whole signal selling CPA thing before, with all these people trying to scam you. Not necessarily that the prop firms are scamming you, but we know the prop firms are relying on the failed challenges, right? So the more people they have failed challenges, the more disposable cash they have to then pay some of the traders that are making money. And I think it was My Forex Funds ran a study before they got liquidated, right? They ran a study to show how many traders were making it from the challenge phase to one payout. It was 0.49%. So it shows how few people are actually getting to that initial payout. And I think that's also because of social media. So people aren't going at these prop challenges like a trader. It's just complete gambling. And the people that are doing really well with some of these prop challenges, I don't know how well they do on an actual live money account, or perhaps say an investor's funds, because they might be buying, say, 5 challenges and getting a huge payout from one. They're maximising the model, fair play, well done. I know people that are making 30, 50 grand payouts on these prop firms, but they may have bought like 8 challenges, or they may have spent a total of 30 grand with a prop firm and they got 80 grand's worth of payouts. It's not really trading. I know you are trading to make the money, but you're just gambling essentially with a slight edge. So they're maximising on that prop firm model, but it's equally not necessarily in line with proper risk management, trading large funds, which is obviously the background I came from before all these prop firms existed. So, and the people I've got in my group that, like Sam, who's got max FTMO funding, for example, he's just looking for a very steady, much like myself, 2%, 4% a month, 3% a month. Those kind of months are great. We can't ask for more than that. But obviously there's a lot of these traders on social media that are taking huge payouts, and then they're marketing that, and the prop firms love that, because then everybody sees this person's made 50 grand, oh, I can do that, I can change my life. Oh wait, no, I failed again, because they're chasing after that elusive, huge payout. So I think there's two things with this model that exists. One is that it's never been easier for us as retail to have access to capital, which is great, right? Because before I would have people ask me, okay, I want to start trading, how much money do I need? Well, now I say, well, you know, you don't really need any, in all honesty. You just need to learn and study and then invest a small amount into a prop firm, a challenge, you know, a reputable prop firm. And that's great because that's given new traders and retail something different now. The barrier to entry is even lower and there's the ability to make some substantial money. So I think the prop firms are great for that, but we've also got to bear in mind that, you know, for every one trader we see on Twitter who's posted the 100K payout, there's probably 100,000 or 10,000 other traders with that prop firm that have spent for 5 challenges and lost the money, right? So I just think being realistic with it is so important still.
Do you use a prop firm yourself?
I do, yeah. I previously traded for my Forex funds. Unfortunately, I don't know if you traded with them, Nick, but we know how that went. So last year I went to bed with quite a decent amount of capital to play with, and because I'm a low risk trader, it'd taken me a long time to pass that challenge, that verification, you know, and this is when we had a period where these prop firms had time limits as well. And I'd extended it because I got to the end and they gave you an extra 2 weeks if you got to a certain point and a certain amount, you know, it was 5% up, I think. Finally got it, got the account into some nice profit, was looking for a payout, which I knew was coming up soon. Went to bed one night, someone in my group said, is anyone with my Forex funds? Of course, I was the only one in the group. And I'd picked them because at the time they were #1 prop firm in the world. So I thought, okay, well, you know, if they go, then the whole industry's looking a bit dodgy, right? And of course there was something going on behind the scenes with them and the account was gone. So I have since secured other prop firm capital, but I look at it very differently now. I look at it as it's there today, gone tomorrow, potentially, possibly, right? So some of the firms like FTMO, I think, you know, they're reputable. They seem to have the market cap. I did think the same about MFF at one point, but they seem to have been around for a long time now, and they you know, they're consistent, right? They don't chat loads of rubbish on Twitter like some of the other firms do and stuff. So I think as long as you just take it with a pinch of salt and accept that you could lose the capital, but at the same time, if you've invested, say, £1,000 or $500 or whatever it is for the prop firm challenge that you've got, and you've passed it and you've had a payout, or you've had 2, or you've had a few payouts, then you're still up in the money. You've not lost any of your own money. Yeah, you've lost a potential income stream, but just don't hang your hat on that income stream. Don't quit your job because you've suddenly got 100K FTMO. You know, that doesn't make sense, because next week they could say, okay, we're ceasing operations. So I think it's just having that, or bearing that in mind moving forward, is really important.
So currently you have your own trading, prop firm trading, your own mentorship program. How do you see your future kind of developing from there?
So I think I'll always trade. You know, I've got a passion for it. I enjoy it. I enjoy the mentoring as well. I'll look to do that as long as I can. Outside of trading, I have a few other things going on, other businesses that I'm currently invested in. For me, something that I'm looking at doing at the moment is moving into wealth management space. So long term, you know, I'd like to work in, whether it's some form of financial coaching or wealth management, financial advice, that kind of thing. So I'm looking at getting my diploma and getting my CII accreditations and all that. But you know, trading for me has been really lucrative, and I've had some really good years, and it's provided the lifestyle that I've currently got. So I would never be able to just leave that behind. There's been points in the past where I've had offers for certain jobs outside of trading, because friends have been in certain businesses within the city, and you know, they've offered me potential roles. But it's so much to step away from, to suddenly go into a full-time job, say in the city, and leave behind the lifestyle I've currently got, which requires very little time on the charts. You know, I'm able to spend my day largely doing whatever I like, but also to then replace the income from trading and what that's provided me over the last couple of years, the last few years. It would be difficult to step away from that. So, you know, as I'm always looking to advance my qualifications outside of trading, because I'm interested. As I've got older, I've wanted to step back into education and learn things, whereas when you're in your teens and your 20s, you think you're too cool for all that, and then as you get into your 30s, you suddenly realise, actually, I wish I'd have, you know, studied this or learnt that. So I'm definitely pursuing other things outside of trading at the moment, but I don't want those things to completely replace trading ever.
Good answer. Long may you continue to be successful. So anyway, thanks so much for being on the show, and wish you all the best.
No, thanks, Nick. Thanks for having me. It's the first podcast I've done, so I've really enjoyed it. It's been different, because normally I'm talking to one of my mentees and doing some form of interview with them, getting them to tell me about how their journey's been. So yeah, I've really enjoyed it. Thank you very much.